We see a lot of red right across the board as earnings week truly kicked off yesterday, and in fact today our episode is quite literally forced as we're covering a company that isn't even reporting this week. Now that is SBUX, which as we can see is down around 5% in the pre-market. We do believe it will continue to fall as the market opens, but again something to keep our eye on, and the reason for this was they released preliminary results for their earnings, which is anticipated to take place next week. Now that is never a great sign. As we can see, they mentioned that their sales fell again, and they've in fact suspended their outlook for the year, which is never a great sign. Now one of the key points here, as we will come to show you, is that they had a massive 10% drop in their traffic in their North American stores, and something that maybe they put there just to make everything look a little bit rosy is they've increased the dividend at around 7%. Now when we do get into the numbers, it truly is very, very poor, so there are no surprises why they did want to just bring this to the market a week before, rather than drop all of this just on the laps of investors who maybe weren't expecting it. Now what the CEO has said, remember he is the new CEO, took place not too long ago. He said that they need to fundamentally change their overall strategy so they can get back to growth, and that is basically what he calls his back to SBUX plan. Now, never a great sign when you hear the words fundamental change, essentially meaning they need to revamp the whole strategy that they have had in place for quite some time. And when we get to their numbers, we can see that their sales actually decreased 3%. That is not a good sign, down to 9.1 billion, and their earnings per share preliminary reported 80 cents. Now how does that compare? Well, firstly, EPS anticipated 103. That is a massive miss, and their revenue, whilst a miss, not as large as the earnings per share. So we're getting here a miss in terms of the top line, a large miss in terms of the earnings per share, and as we will come to show you shortly, this is something that we have seen with this company over the previous quarters. Now this is what we are literally talking about. Their same stores have fallen for the third consecutive quarter. That is a 7% drop in the same store sales, and in fact that is the largest drop they have seen since the COVID pandemic. In terms of geographically, well, in North America we see same store sales down 6%. We then see the actual traffic in terms of people coming through the SBUX stores down around 10%, and the real worry here is China. Their second largest market is down 14%. Now that is very, very large. You may think that right now we are over exaggerating, but this is a large issue that SBUX are facing, because when you come to think of it, if they need to change their fundamental strategy, this is a company that continues to increase their prices on their products, and the issues they have with their top line is their prices are very high. As we can see, consumers aren't coming into their stores as much. So what can they do now to really think about shareholders in terms of driving that growth on the top line, bottom line, as well as the most important overall shareholder return? Another point which is never a good sign, we've seen other companies in the market do, they've suspended their FY 2025 outlook. So what they're essentially saying here is, we don't know what the full year is going to be. They're changing their overall strategy, and they don't want to give any estimations for the overall market. So again, something that we wouldn't consider to be a positive. And perhaps the one positive for dividend investors are they have increased the dividend by 7%, 57 cents to 61 cents. Honestly, that isn't really something that at this point in time we should consider as good news, because the overall company are decreasing in terms of their footfall, in terms of their sales to all of the regions, and this has been going on for at least the last 3 quarters. As we just heard, this is the largest drop since COVID. So lots to consider with this company, and essentially the rest of this particular article does talk about the challenge the new CEO has. Now when we go back to this, as we said, down around 5%, it could be a case that it goes down even lower when the market opens. Over the last year, now this doesn't take into account the fall, so just bear that in mind, it is up around 3%. Over the last 10 years, it is up 155%. We're going to compare this to the S&P later in the episode, and we see all-time highs. You would have to go back now to July 2021, where this was trading at $125. When the market opens, this will probably be trading around the midpoint of the 52-week range. We only have one buy rating from Wall Street, a hold from Seeking Alpha, a hold from Quant. As always, we will run this through our valuation towards the end of the episode. Forward yield 2.35, again we expect this to increase with the drop to forward PE 29.25, again a similar scenario here. Now, the other thing that we want to highlight is how their previous quarter earnings were, and this is something honestly that was very poor. We didn't think it could get any worse. So what this essentially shows us, in terms of the quarter that they had, it was up 1% year on year. Remember, that is lower than the inflationary target of 4%. So in real terms, top line is decreasing. In terms of comparable sales, well, globally it was down 3%, North America negative 2%, international negative 7%, and as we can see, China was negative 14%. In terms of margins, as you know on this channel, we want increasing margins to show operating efficiency. It was down 70 basis points. Again, something we anticipate will show very similar when we get the actual full report next week. Earnings per share was down, global store count was up, but what's the point in increasing your stores if you aren't getting the customers through the door? As we heard, negative 10% footfall, not great at all. Now, their guidance for the full year 2024, in reality, this isn't anything that we should consider because ultimately they continue to miss every single quarter. But for those that are interested, in terms of global revenue, they were expecting low single-digit increase, and for the full year, as we can see to the earnings per share, flat to low single-digit. Now we know this isn't something that is going to occur given the poor performance they have had. And the new store growth, again, what's the point? Why would you continue to increase? Maybe this is what they're talking about in terms of a fundamental strategy. You need to think about increasing footfall, increasing customers buying your products. And right now, in terms of this new store growth, isn't something that we would say is a positive. So we just mentioned their earnings. How have they performed? Well, over the last 4 quarters, 2 of them have been misses. The more recent one was in line, and as we will come to see, quarter 4 that they are officially reporting next week, I believe next Wednesday, is going to be a miss, and in fact showing a larger than 13% drop on a year-on-year basis. Now, whether or not you have faith in management that they will be able to reach the 2025 estimations, remember they have now scrapped the guidance. They do ultimately believe, or had previously believed, was going to be an increase. Now, if they do somehow manage to increase the earnings per share estimate to 382, that will lower the forward P down to 25.4. Now, on this channel, as always, we're going to run through the fundamental metrics. Remember, they may change slightly, in fact, for the better in terms of undervaluation as the share price does drop. But firstly, dividend safety score, 60, borderline safe. Dividend yield theory, we're going to come to show you undervaluation. And we also expect, based on the forward P, given the drop today, another undervaluation signal. Dividend growth, well, 7%, as we just mentioned, it was just increased yesterday with the preliminary announcement of the terrible earnings. And for those that want to know, well, it was reaffirmed in August this year. Ultimately, borderline safe score, there is a moderate risk of a dividend cut over a full economic cycle. We also like to look at some key metrics from the latest recession, the 07-09. No dividend was paid, so no comparative data. Negative 6% sales, which was above the average of the S&P's negative 12. And we can see they did trail the S&P quite significantly, negative 69. S&P negative 55. Now, one thing you can count on SBUX that they have historically done is increase the dividend at a very attractive rate by 17%, in fact, year on year over the last 10 years, and they have been increasing those dividends for the last 13. Now, in terms of valuation, as we said, we are going to run it through our own model shortly, but this is based on the forward P, and in fact, over the last year, and it will come down below this, this company has been trading below its fair intrinsic value, as we can see by the blue funnel here, and right now, whilst it is at the lower end, with the drop expected today, it will be even lower, so you could argue here undervaluation based on this model. And when we take a look in the dividend yield theory, as always, telling us a company is undervalued when the current yield sits above the 5-year average, we have the undervaluation signal here. Forward P as well, giving us another undervaluation signal as it is below the 5-year average. Do remember though, we don't look at any one of these models in isolation. We also note the consumer discretionary sector as a whole in terms of the PE does trade much, much lower. Now, free cash flow power, as always, focus on the free cash flow, not the earnings, which is susceptible to manipulation by management through accounting. Below 50% is what we want. It has been pretty high over the last few years, and in fact, over the next 12 months, 101%, probably one of the reasons why we get that borderline safe score, indicating management are expected to pay out more in dividends over the next year than generating free cash flow. Again, something just to consider. Free cash flow per share, we want consistent increases over the longer term, not something we see, very inconsistent, and in fact, no surprises, it is expected to drop over the next 12 months. Then we get to sales growth. Well, Starbucks from the past was very nice. In fact, we did used to get nearly double-digit increases every single year. Granted, COVID year it did drop, definitely justifiable. Over the next full year, and in fact 2025, I would pretty much with some strong degree of confidence say not to expect anywhere near the growth they have seen in the past. Again, just something to consider. From a numerical standpoint though, over the last 10 years, they have more than doubled their top line, and what they have done on an inconsistent basis is return excess cash to shareholder pockets through those share buybacks. Again, don't count on it moving forwards. In fact, just over the last few years, it has been very, very minimal. Then we move on to the ROIC, 10% or more. Give us faith, management are able to effectively allocate their capital. 12% if you want to be industry specific, and as we can see over the last few years it has been looking very strong, rebounding from that massive drop into 2020 at 9%, so that is a nice positive sign for this company, definitely a metric I do quite like to use. Now, operating margin, we saw from the previous quarter it was down, and as always we want to see operating efficiency at the bare minimum. We want it above the levels that we see for the sector, as we can see for Starbucks pretty much straddling that year on year, and no signs at all of operating efficiency. In terms of free cash flow margin, not too bad, pretty much straddling around the 5% on a year-on-year basis. Now, net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, below 3.5 is what we want to see. Remember, numbers below, number of years it would take the company to pay off all of their debt net of cash on hand, and this metric correlates to both dividend safety, balance sheet strength, which is why it's very important. 2.06 in 2023, about or thereabouts over the next 12 months. So not too bad. Dividend does look to be safe, okay for now. Just remember though, very high free cash flow payout, which could cause some issues moving forwards. Balance sheet, as we will come to see as well, doesn't look too bad. Now, we have just released our latest free weekly article. We drop one every single Monday morning to your inbox, where we talk about undervalued companies that we do believe deserve your attention, as well as essentially updates to the overall market in the last week. So do click on the pinned comment below, sign up, and you can read straight away. You will also be able to gain our monthly access to October stocks, which we see as undervalued, and there's a lot of information here. Also the upside that Wall Street themselves see, and we flag those that are in our portfolio for those that are interested. On top of that, you can grab 22 undervalued stocks that Wall Street themselves believe have the most upside in the S&P 500 at this point in time. So as we said, click on the pinned comment below, sign up, and you can read straight away. Other parts of our analysis is looking at insider movement. Now, there's around 2% ownership. We did see some buys, but I mean very trivial, 35,000, around 2.64 million worth of sales over the last year. But when we look at the more recent quarter, Q4, we see no buys, no sells. Q3, we see some selling and we see that small buy. Q2, more selling, as well as Q1. Now, for full transparency, we will show you. You could argue this is a bit outdated. We have a buy the 6th of September, as we said, a very trivial amount, and the sale by the CEO on the 15th of August, again, quite some time away. Whether or not you believe this is a bullish or bearish signal, the information, the transparency is there. When we look at it from an institutional perspective, well, 72% ownership, around 8 billion worth of sales over the last year, with marginally more buys over the same time period. And when we take a look, we can see in Q3 around the same amount of buys as sales, around the same thing again to explain for Q2. In Q1 though, we see more buying than selling. So overall, you could argue institutions are a little bit undecided, around the same amount of buying and selling, especially in the more recent quarter. As always though, do your own due diligence, never copy what insiders or institutions do. Now, we've already covered their revenue in terms of it's pretty much doubled over the last 10 years, but we do expect this to start slowing down. Really what we want to highlight for this part of the analysis is their bottom line net income. Is it consistent? Is it inconsistent? Well, we can see here it does go up and down on a year-on-year basis, which isn't the greatest because you have revenue that is increasing, but the bottom line net income which doesn't follow suit. It has, although, increased or doubled in fact from 2014 to 2023. Now, in terms of the health of the company, the balance sheet, as we already saw, net debt to EBITDA doesn't look too bad. Their cash as well has been fairly inconsistent over the last 10, going from 1.8 billion in 2014 to 3.4 billion in the latest quarter. Now, how does that compare to their total debt numerically and directionally? We can see it has increased substantially over the last 10 years, although over the last 4 has been pretty much flat, going from 2 billion in 2014 to 25 billion in latest quarter. So something to bear in mind, their debt levels are rising, although stable over the last few years, just to make sure they do keep this under control, especially given the overall business has started to deteriorate and we are thinking about completely and fundamentally changing the overall strategy. Now, in terms of some gradings, valuation D-, and what this essentially tells us is right now this company does trade at a significant premium to the overall market, in fact 70%, and that shows through whatever metric you look at in terms of valuation. If you are buying Starbucks, it is trading at a premium. Is it worth it? Well, that is a question to ask. Typically, we would say yes, but with Starbucks, a lot of negatives to consider, so maybe it isn't as sure thing as other companies, something we'll consider in our valuation model itself. In terms of growth grade, well, C-, look at that revenue year on year, 4%, marginally better than the sector at 2%, and forward looking, this isn't really updated. I don't believe they expect it to be higher than inflation, so below 4%, which is probably around the overall sector. We also note the earnings per share over the next 3 to 5 years is expected to grow around 10%, pretty much in line with the overall sector median. So you could argue right now the growth is pretty much in line with the sector, so it shouldn't really be trading at a premium. Well, that's where we come to our final aspect, profitability, and as we can see, they get an A+. Gross margin, well, actually pretty poor when you look at the sector, much higher at 37% versus Starbucks' 28%. Bottom line though, it is better, 11% versus 4.5%. And one thing that we do like in comparison to the overall sector, cash from operations 6.5 billion versus 276 million. Now, quick recap, there is just one buy rating, that is from Wall Street, a D- on valuation, a C- on growth, with an A+ on profitability. Now, final things before we look at our valuation, how is it compared against others in the sector? We have Chipotle, DoorDash, some very large and well-known names, and total return, including dividends reinvested, they are the worst performance, and when the market opens and this is updated, it will be even worse. When we zoom into the last 5 years, again, one of the worst performing, but you could argue the industry as a whole, unless you've invested in Chipotle Mexican Grill, has been pretty terrible. And then we look over the last 10 years, and we do get a little bit of a different picture, one of the best performing up to 110. Now, you have to consider that past performance won't give us any indication to the future, and right now they are going through a very, very tough period. In terms of comparing to the S&P, well, no surprises, S&P's massively outperformed over the last year. Over the last 5 years, again, we get the same conclusion. Over the last 10 years, interesting to note, Starbucks has in fact outperformed. Very close though, and will be interesting to hear your thoughts if you believe from this point on over the next 10 years, Starbucks can continue this trajectory. So let's jump into the valuation model. As always, if you enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So the first model we're using is the valuation model, companies in a similar sector and size, average PE multiplied by the EPS to give us the intrinsic value with our first undervaluation signal. We then move on to the dividend discount model with the recent increase giving an average of around 8.3% over the last few years. We've gone very, very conservative, 5.75, another undervaluation signal. And then we move on to the DCF model, free cash flow year on year. Average growth around 382, but again, very skewed on a year-on-year basis. We've gone for 10% in line with analyst targets. With the discount rate, we got the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and whilst we have an overvaluation signal here, it isn't too far off the market price, so you could consider it reasonable valuation. Regardless, our intrinsic value today is the average of these three models, and you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether in fact it's for Starbucks or any others that you do desire. We always like to use a margin of safety on this channel as well. 10% is where we start off with and execute if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, well, pretty much a buy at the current price. So we're saying right now at $92, this does give you 10% MOS. For those that want to know, at 15%, a buy at $87, at 20% around $82, and at 25% a buy at $77. As we said though in today's episode, 10% MOS and Wall Street have lowered their price target to around $105. They see 15% upside over the next year, and as we saw, they did give this a buy rating. As always, give us your thoughts in the comments below. Is this one you are looking to buy if it does dip even further today when the market opens? Maybe it's one you're looking to sell, you have no confidence, they continue quarter on quarter to perform very, very poorly. Or maybe you're holding and you're waiting to see what the strategy is from the new CEO. As always, if you enjoyed the content, smash that like button. Don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.